So what if you could get that explosive growth potential of Bitcoin, but also get a steady paycheck from it? I mean, that's kind of the holy grail, right? Well, that's the promise of this really unique fund called the Simplified Bitcoin Strategy Plus Income ETF, or just MAXI for short. But how on earth does it try to merge these two completely opposite worlds? And more importantly, what are the hidden risks? Let's break it all down. You know the classic investor's dilemma. If you're chasing huge growth, like with Bitcoin, you're basically strapping yourself in for a wild roller coaster ride, and you're getting zero income along the way. But then you look at traditional income investments, and yeah, they're stable, but let's be honest, they're not exactly going to set your portfolio on fire. And this is where Maxi walks onto the stage. It's an exchange-traded fund, an ETF, that's been specifically engineered to do something that sounds almost impossible: aim for both steady income and that big capital appreciation. It's trying to blend two investment worlds that, almost never mix. Okay, so here's our game plan for figuring this thing out. We're going to look inside its three core strategies. Then we'll zoom in on how it gets its Bitcoin exposure and where it finds its two different streams of income. And finally, and honestly, this is the most critical part, we're going to dig into the key risks you absolutely have to understand, especially when it comes to taxes and volatility. So the secret sauce for Maxi isn't just one single idea. It's actually a combination of three completely different strategies all working together at the same time. You can kind of think of it like a three-legged stool. Each leg has a very specific job to do to keep the whole thing balanced and standing. So here's the basic blueprint. You've got your engine for growth, that's the Bitcoin strategy. You've got the foundation for stability, that's the income strategy. And then you have this little turbocharger on the side for some extra cash, the option overlay. Each piece is designed to complement the others. So let's see how they each work. First up, let's talk about the engine. This is the part designed for capital appreciation, the Bitcoin strategy. This is what gives the fund its pop, its growth potential, but it goes about getting it in a really specific and, well, indirect way. And let's be absolutely crystal clear about this right from the start. Maxi does not go out and buy actual Bitcoin. So if you're picturing a fund that just holds a pile of coins in a digital wallet, that is not what this is. Instead, it gets its crypto exposure using a whole different set of financial tools. So how does it do it then? Well, it uses a whole toolkit of things called derivatives. For example, it'll buy Bitcoin futures contracts, which are basically just agreements to buy or sell Bitcoin at a certain price on a future date. It also invests in other Bitcoin funds and even uses more complex tools like swaps and options to really fine-tune its position in the market. Now, this is where that active management really comes into play. The fund's managers use their own proprietary model to crank the fund's Bitcoin exposure up or down, anywhere from 50% of its assets all the way up to 200%. What that means is if their model is screaming go, they can actually use leverage to double down on their bet. But if the market's looking choppy, they can dial it way, way back. Okay, let's switch gears and move to the other side of the equation, the income. While that Bitcoin strategy is out there chasing growth, the fund has two other engines humming along trying to generate a steady yield for you. So the bedrock of the income strategy is a portfolio of high-quality government debt. This is the traditional, conservative, pretty boring part of the fund that's really just designed to be a reliable source of yield. The fund invests in some of the safest stuff out there, U.S. Treasuries securities, including the ones that protect you against inflation, known as TIPS. But here's the clever part. These bonds are doing double duty. First, the fund uses leverage to make this bond portfolio bigger, which amplifies the income it can generate. And second, these exact same bonds act as the collateral it needs to make all those Bitcoin futures and options trades. So how does it get the cash to do all that? Well, it uses something with a really complicated name, a reverse repurchase agreement. But don't let the name scare you. Just think of it like a short-term loan. The fund basically hands over its treasuries as collateral, gets a bunch of cash, invests that cash, and then agrees to buy its treasuries back a short time later. It's just a way to make its assets work twice as hard. All right, now for the second income stream. This one's a little more sophisticated. It's called an option overlay, and it's designed to generate extra cash by selling options contracts on all sorts of different assets. The main strategy here is using something called option spreads. The easiest way to think about this is like selling insurance. The fund sells an option and immediately collects a cash payment, which is called a premium. That premium is instant income. But at the same time, it buys a cheaper insurance policy for itself, another option, just to protect against a total worst-case scenario. The goal is just to consistently collect more money in premiums than it pays out for its own protection, creating a nice, steady stream of extra cash. Okay, so we've seen how the fund is built and how it tries to hit its goals. Now, let's talk about the really important stuff, the risks. Because with any complex financial product like this, you have got to understand the fine print, especially when it comes to your taxes and the sheer volatility involved. Now, here is a really critical piece of the fund structure you need to know about. To handle all of its Bitcoin derivatives, the fund uses a subsidiary that's based in the Cayman Islands. Now, this is a pretty common structure for funds trying to meet certain regulations, but it creates a huge tax consequence for you, the investor. And here it is, the big tax takeaway. Normally, if you hold an investment for more than a year, you get to pay a lower long-term capital gains tax rate on your profit. But with MAXI, because of that Cayman Island subsidiary, any gains from it are treated as ordinary income. And for a lot of investors, that means paying taxes at your highest marginal rate, which can be significantly more painful on your tax bill. And hey, don't just take my word for it. The fund's own official document, the prospectus, spells this out in black and white. It's a direct warning that this structure could lead to a less favorable tax outcome for you. This is a real cost that can seriously eat into your actual take-home returns. And beyond just taxes, you really have to appreciate the stack of risks here. I mean, at the very bottom, you have the insane volatility of Bitcoin itself. Then you add leverage on top of that, which just magnifies every single move, up or down. Then you layer on options risk, which can lead to huge losses. And on top of all that, you have the risk that this super complex, actively managed strategy just might not work as intended. So what is MAXI at the end of the day? Well, it's a really ambitious attempt to package the chaos of crypto growth and the stability of income into one simple stock ticker. It is an incredibly sophisticated machine. The real question for any investor isn't just about the potential rewards, but whether you're really comfortable with all that complexity, the layers of risk, and the unique tax quirks hiding under the hood.